NeuPath is Canada's leading chronic pain management company listed on the Venture Exchange with the ticker NPTH. The company is growing both organically and through M&A, achieving $12 million of revenue last quarter and was EBITDA positive for the 7th consecutive quarter ended September 30th of this year. It also recently closed an oversubscribed private placement of $12 million to fund growth initiatives. Joining me today are Grant Connolly, CEO, and Stephen Lemieux, CFO, who will take us through the Q&A, take us through the presentation, followed by a Q&A session at the end. If you have any questions, you can enter them into the dialog box below or email me at tina@adcap.ca. I will caution that the presentation will contain some forward-looking information that may be viewed on the company's website. So with that, I will turn it over to Grant to begin the presentation.
Thank you, Tina, and thank you, Adelaide Capital, for hosting us today. Chronic pain impacts about 1 in 5 Canadian adults, or about 20%. It's estimated to cost between $50 and $60 billion per year in Canada, and between $500 and $600 billion per year in the US. And it's this large economic cost that is driving increased interest in chronic pain at the government level, and also at the employer and insurance carrier level, because employers bear the majority of the cost of chronic pain. NeuPath was established specifically to address this large, growing, and underserved market. So as Tina mentioned, we have the largest clinic footprint in Canada, covers about 67% of the Ontario population. And this large clinic footprint has helped us build up a fairly substantial business. So we're generating about $50 million per year in revenue, and we're EBITDA positive. Despite that scale, we have a lot of opportunity for organic growth. So just based on our existing clinic footprint, we can almost double our revenue, and that's just by doing a better job in terms of filling our existing capacity. At the same time, there's a really interesting M&A opportunity for us. The clinic market in Canada is extremely fragmented, and the approach to chronic pain is inconsistent across the different jurisdictions. And so there's a real opportunity, there's a gap in the market that we intend to fill by acquiring clinics in different jurisdictions and building a truly national chronic pain solution. At the same time as the building out the physical clinics, we're also pursuing a virtual care strategy. So we're big believers in the bricks and clicks model. Through the pandemic, we were able to convert just about 10% of our visits to virtual visits. And we're not at the point yet where medicine is ready to go completely virtual. For the foreseeable future, there is still going to be a role for in-person visits. And that's why we believe having that virtual care strategy combined with the physical clinics is the most complete solution, and it is best for patients. So NeuPath was established in May 2017. It was established through the acquisition of a group of 9 clinics. Then in February 2018, we acquired another group of 3 clinics and effectively became the largest chronic pain network in Canada. We started trading on the Venture Exchange in July 2020. And as Tina mentioned, in November, we reported our 7th consecutive quarter of positive EBITDA. Also in November, we closed an oversubscribed financing. We initially set out to raise about $8 million and upsized it due to the significant interest. So when we look at the chronic pain market in Canada, it's a multi-billion-dollar addressable market. And really, we view the market or chronic pain patients across the spectrum, from higher functioning patients to high impact patients. So higher functioning patients are seeing limited impact on their daily life activities as a result of chronic pain. They're relatively low cost to their employers. High impact chronic pain patients are having a difficult time going to work, going to school, taking care of themselves, or taking care of their families as a result of chronic pain. And what we see is that as patients move from higher functioning to higher impact, their cost to their employer also increases. Chronic pain patients miss about 28.5 days of work per year as a result of chronic pain. And they're also more prone to short-term disability and long-term disability stays. And so when we look at the real opportunity, the opportunity is working with employers and insurance carriers in Canada to try to help reduce some of this estimated $37 billion cost per year that employers are bearing. So again, we're big believers in the bricks and clicks model. And I think that's really one of the things that separates us from other digital health providers. There are a lot of digital health providers that provide the technology, but don't provide the place for patients to go for in-person visits. We view ourselves as a complete solution, so we're providing that virtual care. And I'll get into what our strategy is a little bit later. But we're also providing that opportunity for patients to come in person. We also have a corporate wellness division, and again, our theme really is to provide a complete solution. So we want to provide the physical clinic space, plus the virtual care, plus the corporate wellness option. We're also built on a foundation of research and evidence. So we actually own our own contract research organization, and we really view our patient base as an opportunity to collect data and build research. And so we're in the process of publishing about a 550 patient study, which in the chronic pain world is a huge patient study. We're used to seeing ends of 75 as kind of large studies in chronic pain. So we're really trying to fill that gap in research and evidence in the chronic pain world. So here's a snapshot of our clinical services algorithm, and there are really two important things to note on this slide. The first is that we're offering multimodal care. One of the challenges that we face in chronic pain and in healthcare in general in Canada is that not every care modality that patients should be receiving is actually reimbursed by provincial health insurance plans. And so we've come up with creative ways to try to offer patients different care modalities. In particular for chronic pain patients, it's really important. Chronic pain, we tend to think of in terms of an injury or illness, but it's really much more complex than that. And it's driven by the transition from acute pain to chronic pain is actually driven by biological, psychological, or behavioral factors and social factors. And it's really important in terms of achieving good outcomes with patients to be able to hit each one of those contributing factors. And so we do that by offering our traditional pharmacotherapy, but also supplementing that with their self-management program, which really hits the psychological, behavioral, and social factors. The other thing to note is that, I kind of highlighted it earlier, is that we've been able to transition about 10% of our total patient visits to virtual visits. And so when we look at our clinical services algorithm, we're really looking at where are the opportunities where we can make it more convenient to patients and offer some virtual care. We've hit about 10%. There's an opportunity for us to take that higher. We're looking at converting a good chunk of our initial assessments or initial patient visits to virtual visits, and that should take us beyond that 10% level that we're currently at now. So when we think about our virtual care strategy, the easiest way to explain it is that what we're trying to build is we're really trying to build a teledoc for chronic pain. So you think about Teladoc. Teladoc has the traditional telemedicine option, and they just acquired Livongo, and we're pursuing that exact same strategy in chronic pain. So we've already rolled out our telemedicine offering. And again, the pandemic has helped increase adoption by both providers and patients. And we think there's an opportunity to increase beyond that 10% of total patient visits that we're seeing now. The other really important piece of our chronic pain management strategy is something that we call remote pain management. So I talked a little bit about our chronic pain self-management program, and what we've seen through the pandemic is that program is usually group-based in person. And the pandemic made it very challenging to get groups of people together in the same room. And so we started to look at how we could take that chronic pain self-management program and port it to some digital health technology. And so we're working with a group called Pivot to really understand how physicians, patients, and payers would interact with this technology so that we can build the best possible technology. And really the goal is to be able to provide that chronic pain self-management program in an app on a patient's phone so they can access those tools and that education wherever they are. The other piece of it is coaching, being able to offer patients access to coaching when they need that. And so that's really the technology that we're building out. And we have a real advantage in this space because if you think about a traditional technology or pure play technology company, one of the big challenges that they have is in terms of gathering feedback from users and iterating on that feedback. We, at any given point in time, we have about 15,000 patients rostered. And so we can get to really large numbers of users and get that feedback and iterate much more quickly, plus have access to our roster of pain specialists. So I'm going to turn it over to Stephen Lemieux, and Stephen is going to talk about our organic growth strategy as well as some financial information.
Thanks, Grant. So we have two strategies to grow our business. One is organic growth, and one is growth through M&A, and I'll talk about the M&A shortly. So with organic growth, we measure capacity utilization, which is based on available physician shifts as well as patient appointment slots. And we know that achieving 100% capacity is not realistic. So we've set 80% as our capacity, theoretical capacity. And the numbers that you see below are all based on hitting that 80% target. So to improve capacity, we really have three levers that we can use. One is continuing to onboard new doctors. Two is to continue to expand services that we can offer to chronic pain patients. And the third one is improving our patient throughput. And this is the area where we've really seen significant improvements over the last few years. In 2017, we were at a capacity of approximately 29%, and we were only seeing about 50% of our patients. And this was due to the patient intake process we had in place. So we made some organizational changes to go from a centralized intake process to move that out to our clinics. And with that change, we're now seeing approximately 70% of our referrals, and some clinics are seeing as high as 90%. So we know there's still room for improvement. And if we're able to fill our capacity at our clinics, we have the opportunity to double our current revenue base. On the M&A side, so one of our strategic goals, and Grant alluded to this, is to really reduce our dependence on government payers and to add more third-party payers or employers to our payment mix. The reason for this is some of the services that would really benefit chronic pain patients are not covered by government healthcare. So by diversifying our payer mix, we can not only help improve the treatments that patients can get, but we can help reduce some of that cost we mentioned earlier that employers bear from all the absenteeism related to chronic pain. And one of the other reasons to do this too is to understand the economics of our business. So currently with government pay, for every dollar of revenue, theoretically, we would keep 30% of that and our physicians get 70. But under third-party payers, that similar dollar of service actually generates $2 of revenue, so it's a double. And our split with physicians is 50-50. So we're not only able to grow revenue, but we're able to improve margins. But to take advantage of this opportunity, we need to build out a national network. And this is the message we're getting from insurance companies and employers, because the majority of the employers that could benefit from this service are national employers with locations in most major cities across the country. So for us, there's a great opportunity here because there is a gap in the current Canadian market. No national network actually exists for chronic pain patients across the country. So when we talk about building a national network, we're really looking at building a presence in major cities such as Vancouver, Calgary, Edmonton, Winnipeg, Halifax, and Montreal. And when you look at all these major centers, the landscape for clinics is very fragmented, and the majority of the market is comprised of single center clinics. So when we look into acquiring these clinics, some of the advantages we can offer is efficiencies from utilizing our shared service. So the clinics can really focus on patient care and then access to our proprietary technology platform that Grant mentioned that we're developing with Pivot. On the financial side, before I review the slide, I'm going to walk you through the economics. So as I mentioned before, so on the revenue we generate, we keep approximately 30% of our shares, 30% is our approximate share with physicians. And it costs us roughly 10% of revenue run the clinics. That includes staffing, medical supplies, and technology. So that leaves 20% as a reasonable gross margin. On the adjusted EBITDA side, we currently have a margin of approximately 6%. And if we were to fill capacity, as I mentioned before, a good target would be 10 to 12%. But we can actually grow that number even higher if we're able to execute on our M&A strategy and diversify our payer mix. So through 2020, the business has performed well despite the pandemic environment. You can see on the top left-hand side, so our adjusted EBITDA has gone up to just over 6% of revenue in Q3 compared to 3.5% in Q4 of 2019. And our revenue improved in the quarter to 12 million, which is an improvement from both Q1 and Q2 this year, where the business was impacted by COVID. In the third quarter, revenue was impacted by approximately 5 weeks of physician capacity that we lost due to physicians taking vacations. Normally, we see vacations spread out in the spring and the fall, but with COVID, there was limited opportunity for some of our physicians to take vacation in the spring. So we saw more of that impact in the third quarter. If we normalize for this impact, revenue would have been more consistent with the prior year. On our balance sheet, so Tina and Grant mentioned, we did close a $12 million bought deal financing, which was significantly oversubscribed. So it gives us just under $14 million in cash, which is sufficient to execute on our growth strategy. And we have great upside to grow the business organically. Our current capacity is currently at 55%. It's a slight decline from 2019, which is due to COVID, but we've seen improvements in each of the quarters of 2020. On our capital structure, we have just over 41 million shares outstanding, 72 million on a fully diluted basis. And our largest shareholder is Bloom Burton. They own approximately 31% of the business, and management and the board owns 9%. We do have approximately 18.5 million warrants outstanding. These have an average exercise price of 99 cents, and if converted, would generate just over 18 million of additional capital for the business. Well, there's no direct comparable companies to NeuPath. When we look at our comparable group, we're looking at other companies that either own or operate medical clinics in Canada and the US, or have a combination of clinics and related medical technology. So you'll see this peer group trades on average approximately 10 times 2020 revenue, which is significant compared to NeuPath, which is just under 1 times revenue. So there's significant upside potential in our valuation compared to our peer group, and we'll be able to unlock some of that value as we continue to execute on our growth strategy. We have a very experienced management team and board of directors. So for myself, I'm a CPA by training. I've worked in the life science space for just over 13 years, 8 of those as a CFO. And I've got a lot of operational M&A and transaction experience, which is a great foundation as we've worked together to build the NeuPath business. And I'll now turn it back to Grant to introduce himself.
Thanks, Stephen. I think from a headline perspective, similar to Stephen, I have that combination of both operational experience in healthcare combined with that capital markets and M&A experience, along with experience as an executive officer of a public company. I like to say that Appletree was WELL Health before WELL Health existed, and I say that because they have that combination of bricks and clicks. They have just over 30 primary care clinics, along with their own electronic medical record software. We look at our board, there's that theme carries through that operational experience in healthcare combined with that capital markets experience. So Diane Carmichael, our chair, helped build Best Doctors and sold it to Teladoc for $500 million, but also has experience on the payer side at McKesson. Julianne Burton, one of the founders of Bloom Burton, one of the leading life science focused investment banks in Canada. Dan Legault is the CEO of Antib. Also has experience on the payer side at Green Shield. Joe Wallet's helped build and sell Clementia for over $1 billion and has experience on both Wall Street and Bay Street as an analyst. Sasha is helping to build Greenbrook TMS, a clinic network in the US. Dan Chiquin has good experience on the pharma side, and Grishant Ram is one of the co-founders of Inmedic that we acquired. So again, the market in Canada is, the addressable market is a multi-billion-dollar market. Chronic pain is now starting to get more attention. We're starting to see employers pay more attention to chronic pain just because of the substantial cost. And NeuPath is positioned well to help both patients and employers on the chronic pain front. We have the largest clinic footprint in Canada, and really have that two-pronged growth strategy where we can almost double our revenue just based on our existing clinic footprint. But also there's a really great M&A opportunity for us to fill a gap in the market and really build out a complete solution across Canada, and really a national solution to chronic pain. Combined with that, we're big believers in the bricks and clicks strategy. So that clinic network matches very well with our technology offering. So we've already moved about 10% of our patient visits to telemedicine right now. And there's a really big opportunity for us on the digital health side with our remote pain management technology. Really, the best way to think about that remote pain management technology is that it's much more scalable than telemedicine. Telemedicine, you have a one-to-one relationship between patient and physician, whereas with that remote pain management technology, patients are better able to self-serve, and we can reach far more patients more cost effectively.
Thanks, Grant and Stephen. So as I mentioned before, if you have any questions, you can email me at tina@adcap.ca, or you can enter your questions into the Q&A box below. So maybe we'll start with the organic side of things. Obviously, you mentioned you have capacity to grow. Do you have any thoughts on how that's going to ramp up over the next little while and how COVID's been impacting that?
Yeah, definitely. We saw the impact through Q2 and Q3, and really saw revenue return to kind of normal levels in Q3. What we're still seeing is that existing patients have a much higher comfort level in terms of actually coming into the clinic. So they understand the benefits that they receive from coming into the clinics, and also the health and safety protocols that we have in place to keep patients healthy. Newer clinics, we're seeing a little bit of hesitance, and it's a good thing from a public health perspective, because public health has done a good job messaging and saying, try to limit your opportunities to leave the house. And so that's where we're seeing a really big opportunity for telemedicine to come in and really have more and almost 100% of those initial visits via telemedicine, where there's a higher comfort level. If patients can stay at home, they're much more likely to come for that initial visit. And then after spending time with their doctors and understanding the types of services that we can offer them, and how our doctors and nurses and other healthcare providers can help them, they'll probably be much more likely to actually come into the clinics. And we've seen this in other clinic businesses as well. It just makes sense, and from a public health perspective, it's good to see that people are listening, and we think we have a solution for that, though.
On the virtual care side, is the focus more on converting patients that are in clinic to virtual care, or do you have a strategy for acquisition of new patients through the virtual care program?
It's really both. I mean, that's the beauty of virtual care, is that not that we necessarily need more capacity, but it helps you expand your capacity. We don't need to use an exam room that would otherwise be used for actually treating a patient. We can have those visits virtually. So we've taken a look at our clinical services and really tried to figure out which pathways are best suited for virtual care. So what we're seeing really is the medication optimization or medication management patients. Those are really good candidates for virtual care. Counseling patients are really good candidates for virtual care, and so we've converted as many of those as possible to virtual care. And now the next stage is taking that initial assessment and converting that to virtual care. And to answer your question, really what that means is that it will extend our reach beyond our existing geography. What we see is it's a really unfortunate part of the Canadian healthcare system. Some of our current patients will drive 2 hours to get to one of our clinics. And it's because they don't have access to these services closer to home. And so what that virtual care piece will mean is that those patients who might need our services but are outside of our, our kind of our immediate geographic area, if we can see those patients virtually, at least initially, they can get a better sense of how we can help them, what a treatment plan looks like, and actually start down that treatment plan as well. And then if they need to, actually come in and drive to one of our clinics. So it definitely does expand our reach.
And do you have a target or a percentage target in terms of how much revenue you're targeting for virtual care visits versus in clinic? And does that incorporate, or does the 10 to 12% EBITDA target incorporate virtual care target?
Yeah, it's really interesting because at least for us, it's really early in the virtual care offering. I remember at the end of Q3 when Stephen and I were looking at the numbers, and we saw that our gross margins had increased slightly, even after adjusting for things that we knew about, and really, we kind of came to the conclusion that it was likely because of all of the virtual visits. There's you don't need to staff virtual visits. So, if we see a patient in clinic, then we need to have somebody at reception to welcome them and check them in. We also need a nurse to walk them to the room and triage them and take care of their vitals and other prep work for the doctor. We don't see that with virtual visits. It's really just, the patient clicks on a link, they're communicating with the doctor, and it's over. So there are no staffing costs opposite those virtual visits. If you ask me to quantify it, I don't know that we can. I can tell you that directionally that virtual care is higher margin. Can I give you a number to say this is what we're targeting? No, because we're really still learning about it. In terms of our targets, we kind of look at virtual care in terms of the percentage of visits that we can convert to virtual visits, if that makes sense. We're not looking at revenue because every patient is different, and that really applies for chronic pain patients. If you think about it, because it's driven by biological, psychological, and social factors, every single person in this world is very different from a biological, psychological, and social perspective. So we have to come up with very highly customized and highly personalized treatments for each patient. And so trying to standardize that and say each patient is going to get X is, my doctors would tell me that's really bad medicine. But it's also not really the way to look at our business, if that makes sense.
Yeah, for sure. And then just turning to the M&A side of things, can you talk to some of the opportunities that you're seeing in terms of acquisitions, geographies, what kind of multiples that you'd be paying for an acquisition?
Sure. Yeah, I can take that. So we're pretty established in Ontario, so we're looking at acquisition targets out in Western Canada. So we've got a pretty healthy pipeline. Like, we've been in discussions with like smaller single center clinics that might generate a couple million of revenue to larger clinics that could do upwards of 8 to 10 million of revenue. On multiples, we're kind of seeing a range of 0.5 to 0.7 times revenue, and it really depends on where they are, how established they are in their network.
What would the structure of that look like typically? Would it be kind of an earn-out situation, or would you expect to pay a significant portion up front? Or?
No, it's a combination. So it'd be like some upfront consideration as well as an earn-out as well.
And is it competitive on the M&A side, or are you not seeing too much competition?
We haven't seen too much competition. Like, like I mentioned before, it's not really other chronic pain companies that are trying to build a national network. It's a pretty fragmented market. So it's been, so far, it's really just been us going out and talking to some of these clinics.
And are there any obstacles that you guys are facing in terms of making an acquisition or anything that you guys need to do before closing on another clinic acquisition?
No, I think like with the financing we just raised, that gave us the capital we needed to go and execute on a few of the transactions. Like we say, COVID was obstacles. Like we have been out traveling to go visit some of the clinics, but it's not as easy as it would have been pre-COVID. It just takes a little bit more time than usual. But
in terms of the capital allocation towards acquisitions, what percentage would you be allocating, or how many acquisitions would you be looking to do kind of in the next 12 months versus organic growth?
Yeah, well, I think on that, we're really doing both at the same time. Like organically, like the business is cash flow positive, so we can use capital to reinvest in the business to expand services, and we're continuing to onboard new doctors. So there's not a capital requirement to do that. So the majority of the capital we raise, we can earmark that for M&A. We really want to grow out that national network. So like I think over the course of the year, we'd like to probably close 3 to 5 different transactions to build out that market.
And then once you close those transactions, it's immediately accretive, I guess, or how much onboarding do you need to do with a new clinic?
It really depends on the clinic. Like some of the ones we're looking at would be immediately accretive to the business. Some of the smaller ones where they're establishing they're at the kind of the tail end of their growth they establish themselves in the market. So it might take a few more months, but the majority of them I'd say would be immediately accretive.
There's a question from the audience about medical cannabis. Is this still in the earlier stages, or is there a lot more growth ahead?
Yeah, it's a good question. I think that the way that we view medical cannabis is that it's a treatment option. It's one of many treatment options available, and really depends on the provider as well as the patient. In terms of a business model, I would say that medical cannabis, particularly in Canada, has undergone a lot of changes, and I think that we're really trying to figure out the appropriate business model. We don't believe in the traditional pay for play model where a lot of clinics were getting paid for the script volume that they were generating. We're looking at other ways of unlocking value, but in terms of it adding direct revenue to our business, it's not something that we can point to. It's really our view is it's like a prescription drug, exactly the same if one of our doctors issued a prescription to one of our patients. So we don't have a direct revenue tie to medical cannabis, but we think that there are some interesting business models that we can implement that are good for patients and also good for our business.
In terms of increasing organic growth, you mentioned the addition of certain new services. Can you elaborate on some of the service offerings that you'd be looking to add?
Yeah, I mean, the most obvious is on the regenerative medicine side. There's a lot of excitement around regenerative medicine. Health Canada kind of put the brakes to that. I think it was last year. There were a bunch of clinics and doctors who went out and said, we're offering regenerative medicine, whether that was stem cell therapy or platelet-rich plasma. And Health Canada said, stop. We need to get a better understanding of how these different treatments are going to be used and the impacts they're going to have on patients. And so there are doctors right now, some of them in our roster, who are actually working on studies around stem cells and their efficacy and safety. That would be kind of looking further out. But really, I would say the biggest opportunity for us in terms of adding services is, we look at our business in terms of the publicly funded services and the privately funded services. So right now, we're only generating about 10% of our revenue from private or third-party sources. So that would be, insurance benefits plans through employer group plans. There's a really big opportunity for us there in Canada, and that's really the thesis behind building out that national network. is, being able to work with the national employers who would be more likely to implement these programs and offer them to their employees. It's not going to be the local corner store who's going to offer a chronic pain wellness program. It's going to be the employers that are national in scale, and so you really have to have that network to be able to offer their employees the same service across the country, and that combination of bricks and clicks. You're going to get sick of hearing me say bricks and clicks, but it is really important as well. Being able to offer that complete solution, so the virtual piece combined with the ability for the patients who need it, and there still will be a lot of patients who are going to need to come into clinics to be able to receive treatments.
So there's been a lot of talk, obviously, on the telemedicine side. A lot of competitors or comparators have performed very well over the last few months and this year. Are you seeing any of those competitors move into the bricks and mortar space? And who would you consider your main competitors?
Yeah, I think that you look at and not to say that they're a competitor, but a company like CloudMD really started out as pure play technology and has been acquiring technology as well as physical clinics. And I think that speaks to the real value in telemedicine. People tend to get enamored with the technology, and that's where the value is. It really, our view is that's not where the value is. That we view the technology as a commodity. The real value is in building that marketplace. The patients who want to be connected to doctors via telemedicine, and the doctors who are willing to see those patients via telemedicine. That's where the value is, and I think that's why you're starting to see, or why you're seeing companies like CloudMD and Well Health acquiring brick and mortar clinics, because it's an easy way to build out that roster of physicians who are going to be able to see patients.
Right. So it's a good way to leverage your network, I guess, to increase the digital appointments.
Yeah, absolutely. And I think the thing that doesn't get discussed a lot is that we still have jurisdictional issues in Canada. So one of the nice things about telemedicine is that it really expands your reach and kind of breaks down borders, geographic borders that might exist. But a doctor from Ontario can't see a patient in Alberta without being licensed in Alberta. And so as much as you break down those borders, the borders still exist from a regulatory perspective. So to be able to offer a national telemedicine solution, you really need to have doctors who are licensed in each jurisdiction to be able to see patients in that jurisdiction.
And on the digital health program that you guys are working on, do you have a sense of a timeline of how that's expected to roll out and what investors can expect from a news flow perspective?
Yeah, we're targeting the end of Q1 to have technology in patients' hands, and really, the work we're doing now on the research side by interviewing patients and interviewing payers and interviewing physicians is really important, because what we see in digital health, there was a study that showed that the 90-day user engagement rate for digital health companies is like 27% or some ridiculously low number. And it's because you can solve a lot of problems with technology by building technology, but being able to build a solution that patients and physicians are actually going to use is where the challenge is. And so we're investing a lot in that research piece, and that's why we chose Pivot as well. Is because that's really where they specialize in converting that research and those insights into design. So we could build an app or we could have built an app and had it released by now. But spending that time in researching and properly building out a solution that's going to be usable for patients and physicians is super important for us.
Yeah, for sure. There's a question from the audience about psychedelics and what your thoughts are about people making claims about and touting using psychedelics for pain management. Any thoughts there?
Yeah, I mean, again, I preface all of this with I'm not a medical doctor, but there are studies that show pretty good efficacy for things like ketamine in chronic pain patients. The challenge is the college has taken a pretty hard line with the use of psychedelics in clinics, and I've heard stories about them refusing to allow doctors to administer things like ketamine via infusion in clinics in Ontario. And some companies have got creative by hiring nurse practitioners to offer ketamine lozenges to get around some of the restrictions. So I think that there likely are applications. I think that just like we saw with cannabis, the regulatory bodies move much slower in terms of adopting these new treatments or drugs.
On that topic, I guess, are you seeing any particular trends in chronic pain management or certain pockets of growth in particular?
Trends in chronic pain management or pockets of growth. I can't say that there really are. I think that we haven't dug in because there are just so many patients. Just to put it in perspective, the stats show that about 5% of the adult population would be classified as high impact chronic pain. So again, these are people that are having a tough time going to work, going to school, taking care of themselves as a result of chronic pain. You look at the Ontario population, and that represents about 700,000 people, if I did my math right. In Ontario, I think the numbers are from 2018, 2019. Only about 51,000 people received treatments for chronic pain. And you see it in the hospital-based pain clinics that have 2 to 3 year wait lists. It's because there are more patients than we really know what to do with. And so really it's about connecting with those referring physicians, making sure that they know that we're an option and that we can help out. Because what we see as well is that some of those hospitals that have the really long wait times are actually redirecting patients to us because they just can't deal with the volume of patients. So I think it's really about trying to figure out how to reach those patients and offer them care in a more scalable way. And I think that's where our remote pain management technology can become really helpful, because if we're able to execute it right, it's not just something that patients could use for self-management. It can also be a patient acquisition strategy as well. If patients tried out, their family doctor gets some of the reports, it could lead to better education on the family doctor side in terms of the options that are available.
Yeah, I think there's also something to be said about preventative pain management as well. I think we're seeing a lot of, you can see the economic benefits of managing your pain before it's too late, and employers can see that as well. So I think that's a big area that'll be growing as well.
Yep, absolutely. Yeah, and I think that I read a stat, and they're American numbers, but I think 80% of companies that have more than 200 employees in the US have some form of wellness program where they're doing exactly that. They're encouraging their employees to be a little bit more proactive in terms of their health. And it's because they understand the economics. They know that healthier employers are more productive and more likely to be at work. And we're seeing that, and we're seeing that in Canada as well. I think the real challenge, though, is that a lot of these service offerings are a per employee per month charge, whether the employee uses it or not. And based on our work with on the benefit side and with some insurance carriers, employers are starting to get fatigued. They're paying a per employee charge for mental health. They're paying a per employee charge for payroll, and all these other things, and they're kind of done with the per employee per month charge, whether they use it or not. And we see it as well as an employer. We use these services too, and we look at our usage rate. How many of our employees are actually accessing these services. So it's figuring out how to offer these services in a way that's economically beneficial for employees and gets past that monthly charge fatigue, if that makes sense.
Mm-hmm. We are out of questions on the Q&A, but let's talk about valuation for a minute. So if anyone has any last minute questions, feel free to input them. But you're obviously trading at a significant discount to peers. Why do you think that is? And what do you think will close the gap between your peers on a valuation standpoint?
Yeah, it's a great question. I think that we're relatively new. A big part of the exercise is getting the word out. I think that one of the things that will help is, once we do start announcing acquisitions and people can start to see that strategy play out, I think we'll get a little bit more credit. Right now, we talk about acquisitions, and I promise we are going to close. but until you start executing, it's tough for investors to see, or some investors want to see it play out before they're willing to take a jump. I think that companies like Well Health and CloudMD have done a great job in terms of educating the market about the value in businesses like ours. They're a little bit further along in terms of executing on their strategy, and they're probably have conditioned the market a little bit in terms of expectations around deal flow. We're taking a little bit more measured approach. We're playing the long game, and we want to make sure that we make the right acquisitions. And I've been on both sides, both selling businesses and buying businesses. And the way I think about it is buy slow, sell fast, right? If you're selling a business, you can't get it closed fast enough because there's so many things that can go wrong, and so much stuff that the buyer can learn about in the diligence process. So you really want to sell fast. And I look at it from the buying process, and we're spending a lot of time with our targets and learning more and just becoming more educated. And it's not that we're finding challenges. I think that we're, if anything, we're seeing opportunities and opportunities for, in particular, revenue synergies. We get asked that question a lot. Or is it 2 + 2, chop some from the target? And we're not really seeing that. We're seeing a lot of really businesses that are being run very lean, and what we can bring to them is the back office stuff, the accounting, the HR, maybe some help on the marketing and IT as well. But there really isn't a lot of opportunity to cut. What we're really seeing is on the synergy side is more on the revenue. What we can do together. What you're doing that we can bring into our business, and what we're doing that you can bring into your business.
Yeah, I think the company's obviously newer to market. The financing drove a lot of interest, so I think that speaks to the opportunity that investors see. And then once we get some of the execution on this M&A, I think it'll drive a lot of eyes to the story. So we'll wrap it up from there. But maybe you can give us a couple words on upcoming catalysts, what to expect, and why you should be following NeuPath.
Yeah, thank you. I think we're fundamentally very strong. I think that oftentimes when we speak with investors, there's a lot of shock around the fact that we've built up a business that's generating $50 million in revenue and is also EBITDA positive and has been EBITDA positive for almost 2 years. It's kind of rare in the Canadian healthcare space, particularly in the clinic space. Catalyst, really watch for acquisition announcements. We did raise that money with a purpose. Go to our use of proceeds, as you said to me in a conversation earlier. I was looking at your use of proceeds, and I can see what's going to happen. We will use that capital and deploy that capital in a really smart and strategic way. So those would be the big near-term catalysts to watch for. And we're doing more of these types of events over the next month or two. just really to raise awareness and get people familiar with the story.
Well, great. Well, thanks for the presentation. It was great to get a little bit more insight into NeuPath, and looking forward to following the story. Appreciate it.
Thank you, Tina. Thank you, Adelaide Capital, as well.